So let's do published financial statement. Published financial statements. May 2018, question 2. May 2018, question 2. Can start with question number 1. So question 1 of May 2018. Yeah, that's accounting for assets and liability as 20 marks. But in the context of IPSAS 19, provision, contingent liability, and contingent assets, distinguish between a provision and a contingent liability. We say that a provision is a liability which arises as a result of past events, right? Of which the company expects some future outflow. Then contingent liability, we say that it's a liability whose occurrence will be confirmed or whose existence will be confirmed by the occurrence or non-occurrence of an event. You don't have to write that. You have them in your notes. So I'm just trying to remind you. Then number 2, summarize the recognition requirement for provision, contingent liability, and contingent asset. You see that provision should only be recognized if probability of occurrence is more than 50%. And then contingent liability and contingent asset, both of them, they should not be recognized. They should only be disclosed. That's all, nothing else. That contingent liability, contingent asset, they should not be disclosed, they should not be recognized, they should only be disclosed. Number B, with reference to IAS 12 income taxes, distinguish between a deferred tax liability and a deferred tax asset. We say that a deferred tax liability is the tax payable in the future, which arises as a result of taxable temporary difference. Then deferred tax asset is tax recoverable in the future, which arises as a result of deductible temporary difference. Number 2, explain 2 types of temporary difference. We have taxable and we have deductible temporary differences. Number 3, describe the basis of measurement of the current tax liability and the deferred tax liability. I showed you how to get the tax expense. We say that the tax expense is made up of the current tax, and you need to define what's current tax. Is a tax based on taxable profit for the year, and then for deferred tax, you consider the changes. We say that an increase in deferred tax is an expense. A reduction in deferred tax liability becomes a what? Becomes an income. That's what we are supposed to explain. You get your 20 marks. So now let's do part 2. Part 2 is on published question. Now, the foreign trial balance related to Zambezi Limited as at that 1st October 2017. We have turnover, cost of sales, trade receivables, bank balance, distribution expenses, inventory that 1st October 2017, that's the closing stock, interest expense, administrative expenses, rental income from investment property, plant and equipment cost, land and building at valuation, accumulated depreciation, plant and equipment, investment property at valuation, trade payables, joint arrangement, deferred tax, ordinary share, we have 10% redeemable preference shares. Then retained earnings, and we have revaluation surplus. Additional information. An inventory count on that 1st October 2017 listed goods with a cost of 10.5 million. So that's the value of the closing stock. So can you confirm whether the inventory in the trial balance is it 10,500? And then you're told that this includes some damaged good that had cost 800,000. This good would require repair costing 450, after which they could be sold at an estimated price of 950. So we have damaged good and we have inventory value. They have a value of 800, which needs to be repaired. The goods will require to be repaired, repair work costing 450. You add repair costs. We have to repair them at a cost of 450. So that means how much is the carrying amount? The carrying amount is an amount of 1250. After which they could be sold for estimated price of 950. Then the recoverable amount you can recover, it's only 950. So there is loss of inventory of how much? Amount of? So we have 300. So how do you treat these 300? If the carrying amount is 1250, but you can't recover 950, this loss of 300, you add it to cost of sales, then you eliminate from the closing stock. Number 2, non-current assets. Number 1, all plant, including that of joint operation, is depreciated at the rate of 12.5% per annum on reducing balance basis. So let me take you to note number 5. First of all, let's go to note number 5. On 1st November 2016, that's the beginning of the financial year, Zabez Limited entered into a joint arrangement with 2 other entities. Each venturer contributes their own assets and is responsible for their own expenses, including depreciation on assets of the joint arrangement. Zabez Limited is entitled to 40% of the joint venture total turnover. The joint arrangement is not a separate entity and is regarded as a joint operation. Details of Zabez Limited joint venture transaction are as follows. So we have the plant and equipment at cost, share of joint venture turnover, 40% of the total turnover, related joint venture cost of sales, excluding depreciation, trade receivable, trade payable, and then we have balance as per the trial balance. So that's a joint operation. So we'll have to consolidate. It's a going concern business. So now we can go back to note number 2. Note number 2. Number 1, we are told that all plant, including that of joint operation, is depreciated at the rate of 12.5% per annum on reducing balance basis. So depreciation of PPA. So plant depreciated at the rate of 12.5% reducing balance. How much is the value of the plant? The value of the plant is how much? We have that 6,000, but they're using reducing balance. So therefore, you have accumulated depreciation, which is 16,800. Give me that. $2,100. Have the plant for the joint venture. You still take 12.5%. Note number 5. Note number 5. The plant and equipment, the cost is 12,000. So they provide a depreciation of how much? Sorry? 15 or 18? 1500. So how much is the total depreciation? That's 9. Then the second bullet, we have landed building. Landed building. The landed building were valued at 15 million and 48 million respectively on 1st November 2016. So now 1st November 2016, that's the beginning of the year, creating a 21 million revaluation surplus. So already given the revaluation gain. At this date, the building had a remaining useful life for 15 years. So we made a revaluation of landed building, but we made at the beginning of the year. So land building is a depreciable item. Therefore, we need to determine the depreciation. So building was evaluated to an amount of 48. And then as at the revaluation date, it has a remaining useful life for 15 years. So how much is the depreciation per annum? That's 200. With that bullet. Now, depreciation is on a certain basis. The base limited does not make transfer of realized profit in respect of excess depreciation. Depreciation on both building and plant should be charged to cost of sales. So this depreciation, you take it to cost of sales. Also, this depreciation, you take it to cost of sales. Investment property. So let's go back to the trial balance. Trial balance. How much was the value of the investment property? Where's your paper? Yes. Investment property. How much is the amount? 16,000. You are told that on that 1st October 2017, a qualified surveyor valued the investment property at 13,500. So was it a gain or loss? We have a revaluation loss of 2,500. So how do you recognize this? Revaluation. You take it to other incomes. Then you're told that the company uses the fair value model as per IAS 40, investment property, to value its investment property. We see that items measured at value at fair value, their revaluation changes should be taken to other incomes, not other comprehensive income. Number 3, interest expense include overdraft charges, the full year preference dividend, and ordinary dividend of shillings 4 per share that was paid on April 2017. Interest expense. How much is the interest expense? Let's go to the income statement. Amount of. Then you are told that interest expense include overdraft charges. So interest charges qualifies to be part of overdraft, to be part of finance cost. Full year preference dividend. Remember the preference shares were redeemable. So that one is a liability. So that one qualified to be part of preference, the finance cost. And ordinary dividend. Dividend is not an expense. It's just a distribution of profit back to the shareholders. But they included under finance cost. Ordinary dividend of 4 per share. So you eliminate that. You raise ordinary share capital dividends. So how much is the ordinary share capital? Give me the ordinary share capital. So ordinary share capital, you have 20,000. You divide by the par value. The par value is 25. You get the number of shares. Then each share was entitled to a dividend of 4. So how much was the dividend? Sorry? That's 200. So how much will be the finance cost? An amount of 1,800. Not 5,000, should be 1,800. Let's go to note number 4. Number 4. The director have estimated the provision for income tax for the year ended that 1st October 2017 at 8 million. So whenever you see tax, what comes to your mind is your tax expense. And we say that tax expense is made up of current tax and changes in deferred tax. And we are told that the directors have estimated the provision for income tax for the year ended that 1st October 2017 at 8 million. So the current tax is 8 million. The deferred tax provision as at that 1st October 2017 is to be adjusted through the profit and loss statement to reflect that the tax base of the company net asset of 12 million less the carrying amount. Tax rate is 30%. Let's go back to the 12 balance. How much was the deferred tax balance brought down? The opening balance is 5,200. You compare against the closing balance. Closing balance of the net taxable temporary difference, which you are told is 12,000. 30% of that is that 600. So the opening balance was 52 and the closing balance is 36. An increment or a reduction? A reduction of how much? $1,600. Say that a reduction in deferred tax is a what? So therefore you deduct. It will reduce your tax liabilities and income. So how much will we pay? Pay amount of 64. That's what you take to the income statement. Number 5. On 1st November 2016, Zabez Limited entered into a joint arrangement with 2 other entities. Each venture contributed their own assets and is responsible for their own expenses, including depreciation on assets of the joint arrangement. Zabez Limited is entitled to 40% of the joint venture total turnover. The joint arrangement is not a separate entity and is regarded as a joint operation. Details of the Zabez Limited joint venture transaction are as follows. So you are given that. Now required statement of comprehensive income and then statement of financial position. So now with that, before I present, let's adjust some expenses. Remember, we say that the income statement expenses are classified into 4. It's either cost of sale, admin expenses, distribution, or finance. So admin expense and distribution were not affected. We have already adjusted the interest expense. So what we need to adjust is the cost of sale. Cost of sales. How much was the cost of sales? So for the cost of sales, the balance brought down is 143,800. Then you add, you are told that depreciation of assets to be taken to cost of sales. Take that 900. Then we had that 200. And that one you get 7,100. Then let's go to note number 5. Note number 5. Note number 5, we have related joint venture cost of sales, excluding depreciation. It's an amount of. So we have joint venture cost of sale, an amount of 5,000. So give me the adjusted. 155. 155,900. Then we also say that PPE should be recognized as a single element. Therefore, let's work for PPE. PPE, we have land, we have building. Also, you can see we have plant and equipment. How much is the value of the land? Note number 2, the second bullet. The land and building were valued at 15 million. Then building was revalued to 48, but we charged a depreciation charge of that too. How much will be the net book value? This is that 200, that one will be 44,800. Then we have plant. Plant had a cost of that 6. There was accumulated depreciation of 16,800. There was a depreciation charge for the year of 24. Then also we have plant for joint operation. The cost was 12,000. Then there was depreciation of 1,500. So give me that. Still 16,800. 10,500. So how much do you take to the balance sheet? Sorry? 87? 87,100. So now we have that. So now let's present the statement of comprehensive income. Zambezi Limited. Of comprehensive income for the year ended 31st October 2017. So we start with the sales. You deduct cost of sales. You get gross profit. Then under other incomes, we have rental income. We also had fair value loss. Then you deduct other expenses. We have administrative expenses. Then we have distribution expenses. We have finance cost. Then you get your profit before tax. Then you raise the tax expense, you get the profit after tax. Then you add other comprehensive income. There was revaluation of rendered building. Then you get total comprehensive income. So how much is the value of the sales? Sales we have 213. How much was the rental income? We have 1,200. Then we had fair value loss on investment property. We see that you take it to other income. This loss of 25. Then admin expenses was not affected. So how much was the admin expense? 12,600. Then distribution expense. $9,800. Finance cost was affected. We had, what do we take to other comprehensive income? Can we go to note number 2? Where we have land and building. The land and building were valued at 15 million and 48 million respectively on 1st November 2016, creating a 21 million devaluation surplus. So devaluation gain of an non-current asset, we see that they should be under other comprehensive income. How much will it take to other comprehensive income? Take 21. So with that, you have 1, 2, 3, 4, 5. Then the sale, any 5 at 2. You get how many marks? So you have not adjusted any. Are you together? That's what we call working smart. So kindly don't leave out a published question, regardless how hard it is. This is why you get a lot of marks. Good. So now let's adjust. We have sales, which is 3,800 plus. Let's go to note number 5. We have joint venture. Share of joint venture turnover, it's 40% of the total turnover. It's an amount of. So give me that. $221,800. Then cost of sales. Cost of sales was 155, but we never adjusted this. We had loss on inventory of 300 we are supposed to add. So it's 155,900. Then you can add this, the loss of inventory. We say that you added to cost of sales will made from the closing stock, an amount of 300. So that one will be 156,200. So give me the gross profit. The gross profit. Sorry? 65,600. So we have other incomes. I have rental income, fair value loss, admin distribution. Then you have finance cost. So finance cost is 1,800. So now give me the profit before tax. Yes. 4,100. Then you deduct tax expense. At the tax expense, we have a 6,400. So give me the profit after tax. 33,700. Once you get the profit after tax, you add a revaluation gain of 21. That one you get 54,700. Number B, we are to present statement of financial position. Sabes Limited. Statement of financial position as at 31st October 2017. Start with the assets. Non-current assets, we have PPE. We also have investment property. Then we go to the current assets. So how much is the investment property? Give me the value of investment property. We have? So 13,500. Then under current assets, we have inventory. We have trade receivables. We have trade receivables. Payables not 15, right? It's 2,500. So it will be how much? To change the totals? That's 14,300. Also for the trade receivable, you'll have to change this, 13,500. Let's add the one for joint venture. Joint venture, it's an amount of? Yeah, it's an amount of 1,500. How much do you get? Is that 15,000? 15,000. So now let's adjust. PPE, how much is the value of PPE? Have 87,100. Current tax, we have inventory. How much was the value of inventory? You have 10,500. You minus, there was this loss of inventory, an amount of 300. Do you have any from the joint venture? No. So you'll have an amount of 10,200. Then to the equity, we have ordinary share capital. Then we have retained earnings. How much is the value of retained earnings? It's 17,500. You add profit after tax from the income statement, that's 700. Then you deduct dividends, ordinary share capital dividends of that too. Yeah, the one we eliminated from finance cost. So what do you get? Sorry? You're saying what? Is that 14,000 or 100,000? What else don't we have? I think we have it. Let's try to balance that. Let's try to balance that. Which one? You have 300. $125,800. 125. So you can take a screenshot of that. illustration. December 2013. December 2013, question 4. December 2013, question 4. Question area for one student. December 2013, question 4. So let's do that question. That's December 2014. Sorry, that 2013, December 2013, question 4. So we are told that Meta Limited, a company quoted on Security Exchange, has prepared the following to a balance as at 30th September 2013. So we're given the revenue, purchases, we have distribution cost, admin expense, inventory on 1st October 2012. Now that's the opening stock. Then we have interest paid, tax, dividend paid. We have PP at cost and accumulated depreciation. Then we have suspense account, trade receivable, cash and bank balance, trade payable, allowance for damages. Then we have interest bearing borrowings, lease rentals, deferred tax, ordinary share capital, and then we have retained profit as at 1st October 2012. Additional information, number 1. Number 1, you are told that inventory as at 30th September 2013 was valued as follows. So we are given closing inventory. So we are given the net realizable value is 68,500. Then the cost is 66. So how much is the value of closing stock? Good, 66. Remember we said that you recognize the closing stock based on the row of either the cost of net realizable value. So it's 66. So once we have the closing stock or additional information, that means we are not given the cost of sales. And to get the cost of sales, it's opening stock plus purchases minus closing stock. So how much is the opening stock? We have 54,600. Then you add purchases. Yeah, purchases is 225,000. And then you raise the closing stock, which is 66,000. So the value of the closing stock, therefore, will be an amount of 213,600. Number two, you're told that admin expense. So how much is the admin expense? Yeah, admin expense is an amount of 78,000. Then you're told that, number 2, admin expenses include an allowance for damages for a customer whose order was not delivered on time. The customer is seeking that million shillings in damages, and the lawyer have advised that there is a 40% chance that the customer will be successful. Should we recognize that provision? We should not recognize that provision since the probability of occurrence is less than what? 50%. Yeah, you see that you only recognize a provision only when the probability of occurrence is more than 50. So this one should not be recognized, should only be disclosed. A provision for damages amounting to 12 million has been made. So in your admin expense, deduct that provision of 12. You have an amount of 66. Number 3, current year tax. So number 3, it's all about the tax expense. We say that the tax expense is made up of the current tax and the changes in deferred tax. And we are told that current estimated at 4.5 million. That's the current tax. Then you are told that the tax of 600,000 in the trial balance is the previous year estimate. The net taxable temporary difference amounts to 84 million with an average tax rate of 25. Yeah, temporary difference is what gives rise to deferred tax. So how much was the balance breakdown for deferred tax? Let's go back to the trial balance. Deferred tax is an amount of 18,000. Then to get the balance, you take the tax rate is 25%. You multiply by the taxable temporary difference, which is 84. 42, that's 21, right? So the opening balance or the balance breakdown was 18,000 and the provision at the end is 21. There is an increment of how much? So an increase of 3. So we say that an increase in deferred tax becomes a what? An expense. So you'll pay a tax of 75. Together. Yeah. And then the balance carried down of 21 is what now you take to the statement of financial position as part of non-current liability. Good. Number 4, property, plant, and equipment comprise. So we have land, building, plant, and equipment. You have the cost, and then you have the accumulated depreciation. Number 5, buildings are depreciated at the rate of 2% based on cost, while plant and equipment are depreciated at the rate of 25% based on cost. No depreciation is charged in the year of disposal. So number 5, depreciation of PP. So we have building, we have plant. And we are told that buildings are depreciated at the rate of 2% based on cost. So we'll take 2%. Note number 4. How much is the cost of the building? 54. 10,800 divided by 10. You get 10? 1080. And then you're told that while plant and equipment are depreciated at the rate of 25% based on cost. So 5%. How much is the cost of the plant? 81. Let's go to note number 5, number 6. The balance in the suspense account represents sales proceeds of an item of equipment, which cost how much? Yeah, of this plant, this cost. You see, we are told that no depreciation is provided in the year of disposal. And number 6, we are told that the balance in the suspense account represents the sales proceeds for an item of equipment, which cost 18 million. So of this 81, there is an item of equipment which you dispose during the year, which at a cost of how much? So you eliminate the cost of the disposed item. So you take 25% of the remaining assets. What do you get? $15? 750. Then let's go to number 6. That the balance in the suspense account represents the sales proceeds of an item of equipment which cost 18 million. So number 6, we had disposal of equipment. So we have the disposal proceed. How much was the disposal proceed? Yes. So we told that the suspense account. How much was the suspense account? We are told that the balance in the suspense account represent an item of represent sales proceed for an item of equipment which cost 18 million. The item was sold during the year and an accumulated depreciation of 13.5. So if the disposal proceed in suspense account is that 5, and then the item we disposed had a costed 18 million, and then an accumulated depreciation of how much? 13,500. So how much was the net book value at the date of disposal? That's 4,500. The net book value was 4,500, but we sold that item at that 6. Did you dispose at a gain or loss? So loss on disposal, a loss of 900. Good. Then you are told that any gain or loss is reported to the relevant depreciation expense. Any gain or loss should be reported under depreciation expense. So depreciation of plant was 15,750. Then being a loss is an expense, so it will increase the expense. You are, so that one will be 16,6. Yeah, 16,650. Good. Number 7. There is rental related to some plant leased on 1st October 2012. So that's at the beginning of the financial year at a fair value of 93 million for a period of 5 years. The lease rental are paid 6 months in arrears, and the implicit interest rate is 5% for the 6 months. So whenever you have lease, we prepare what? A lease amortization. Lease amortization schedule. How many years? Good, 2 years. And then, is this lease payable in advance or in arrears? Payable in arrears. So therefore, period, balance brought down, interest at the rate of 5%. Then we have the payments. Then you determine the principal. And then you determine the balance carried down. So it's 2 years, year 1, but you are paying semi-annually. Year 2, 2 times. So how much was the carrying amount? $93. Then the interest is 5% for 6 months. So now let's take 5% of 93,000. 46? 4650. How much was the payment? Let's go back to the 12 balance. The lease rental payment is how much? 24,000. But that 24,000 is for the entire year. That's what given financial statement for the year. So if you are paying 24, that means for 6 months is 12. Even the second year, the same. We see that the payment will always be the same for the 5 years. 12. So the payment was 12 for the 6 months. So how much is the principal? We see that the payment of 12,000 includes both the interest and what? And the principal. And of this 12,000, you already know that the interest is 4650. Therefore, how much is the principal? So take 12,000 minus 4650. 73? 7350. Give me the, wrote it down. You deduct principal. Sorry? 85,650. Then the balance carried down becomes our opening balance. 85,650. Percent of that is how much? 4282 point. Then we paid them 12 million. So take 12 minus interest. How much will be the principal? 77? 75? 5. Therefore, give me the balance carried down. You take the opening balance, you minus the principal. Sorry? 77? 9, that's 2 point. Then the balance carried down becomes the opening balance, 77% of that. 3890.6. That minus that, how much will be the principal? 810.375. So the balance brought down minus the principal. Yes. One, 2, 5. Then that one becomes our opening balance, 69,829.125. 5% of that, 3491. So 12,000 minus answer. Yes. 508.5. So therefore, give me the balance carried down. One. 0.5. Good. So now with that information, so what do we take to the income statement? What do you take to the balance sheet? So that the income statement you take for the first year of operation, that's first year, and you have to present depreciation and what? Interest. Then to the balance sheet, you take the details for the second year, and we have non-current liability, and we'll be having current liability. So let's start with the one taking the income statement. Depreciation. So depreciation will take the cost, which is 93. Then the lease period was how many years? We divide by 5 years. So much depreciation per annum? 18,600. Then interest. How much is the interest? You add the interest for the first year. You get? 0.5. Then to the balance sheet, what do you take the non-current liability? We say that when paying in arrears, you take the balance carried down, and then to the current liability, you take the principal. So give me the balance carried down for the second year. So we have 61,320.5. Give me the principal. We add the principal for the second year. That's what you're getting. That's what you're getting, right? So we are through with that. Note number 8. The allocation of depreciation on PPE should be on the following basis. So that's the allocation of depreciation. So how much was depreciation? Total depreciation, we had for building 1080. Then you add for plant 16,650. That one 730. So how to allocate it? Allocation of depreciation on PPE should be on the following basis. 80% to cost of sales. So to cost of sales, you take 80% of 17,730. 10% to distribution cost. Distribution, you take 10%, 17,730. And then to admin, 10%, 17,730. This one is 1773, 1773, 14, 184. Then you told that for the plant on lease, the depreciation is a full cost of sales. So to the cost of sales, you add the entire depreciation, which was 18,600. Good. Required a statement of comprehensive income and then a statement of financial position. So now before we present that, remember we said that expenses are classified into 4. So let's compile them. Cost of sales, administrative expenses, selling and distribution expenses, and we have finance costs. So let's start with the balance broken down. How much is the cost of sales? $213. How much is the admin expenses? 66,000. Distribution, 21,000. Finance cost, 9,000. Then to the interest, you add this finance cost on lease. We had an interest of 8932.5. So it will be an amount of 17,932.5. Then we adjust depreciation to cost of sales. You are to add 14,184 plus 18,600. To admin, you add an amount of 1773 for depreciation. Distribution 1773. So this is 22,773. 7,773. Let's compute PPE. PPE. How much are you getting for cost of sale? So let's do PPE. We have land. We have buildings. Then we have plant, right? How much is the value of the land? Note number 4. Land we have is 36. Building you take 54. There was accumulated depreciation of 13,500. Then you less depreciation charge for the year, which is 1080. Then we also had plant. Plant you'll take, it's 81 minus, we sold an item of equipment which had cost 18 million. How much is that? Or alternatively, you can do this. For plant and equipment, the amount is how much? How much is the carrying amount? Take 81, you less depreciation of that 3. How much is the carrying amount? That will vary. Sorry? 47? 730. So you take 47,730. That's book value. Then you deduct the net book value of the disposed item, which was 45. Then you raise depreciation charge for the year for the plant. How much was the depreciation? 15,750. Then you also capitalize the leased plant. We had leased an item of plant. How much was the cost? 93. Then there was a depreciation of how much? 18,600. So what do you get? That's 9? Uh-huh. 420. So now add the total. Add the total. On 77? 300. So PP should be recognized as a separate item. So now let's answer now the question. Number one, you have to present the statement of comprehensive income. So Meta Limited. Statement of comprehensive income for the year ended 30th of September 2013. Take revenue, deduct the cost of sales to get the gross profit. So the amount of revenue is 390. Less cost of sales. Give me the gross profit. $15, 956. Do you have any other incomes? Confirm whether you have other incomes. Don't have any other income, so therefore we deduct expenses. Expenses we have administrative expenses, distribution expenses, then we have finance expense. That's how we get the profit before tax. So admin expenses to 67,773. We have 22,773. Then we have 17,932.5. So give me the profit before tax. You're getting 24. Sorry, 34.5. Can you give me your calculator? To 13,600 for 184, 18,600, 246, 384. That's the profit before tax. Then you raise tax. Expense, tax expense was 7,500. So our profit after tax will be 27,637.5. As simple as that. So let's present the balance sheet. Meta Limited. Statement of financial position as at 30th of September 2013. So we start with the assets. Non-current assets. What do we have to the non-current asset? We have an amount of 177,300. What else do we have? Go to the current assets. We have inventory. How much the value of inventory? Take 66. We have trade receivables. How much is the trade receivables? 148. 148,000. And then we have cash and bank balance. An amount of 121,370. So then we go to equity and liabilities. We have ordinary share capital. How much the ordinary share capital? We have 150,000. Then we have retained earnings. So retained earnings, we have a balance of, take it to 1,000. Then you have the profit after tax of 27,637.5. Then there was dividend paid, 6,000. What do you get? 102? Sorry? 0.3? 0.5. Do we have any revaluation? So we go to the non-current liability. We have deferred tax. How much is the value of deferred tax? 21,000. Then we have lease obligation. Lease obligation. We have 61, 20.5. Then we have interest-bearing borrowings. Those are borrowings. And borrowings is an amount of 120. Then we have current liabilities. So to the current liabilities, we have current tax. How much is the value of the current tax? Current tax is 4,500. You add 600. You get 50. Can we go to note number 3? The current year tax is estimated at 4.5. Then you're told that the tax of 600,000 in the trial balance is a previous year estimate. So for the year we were charged 45, and previously we have a balance brought down of a bit of 600. So that means you owe KRA 5,100. Then we have trade payable. How much is the trade payables? Trade payable is an amount of 36. Then you also have lease obligation. $16, 6, 12. Trade payable is how much? That's 6,000. Have we captured everything? Yeah, I think so. So now let's try to harmonize that. You still get 512, 670. Let's take a screenshot of that. Should we do another question or just call it a day? I feel tired. Kama mwende nyumbani. I just bereft with online student. It seems they are more motivated to run than you are. November 2017. Question 2. November 2017, question 2. Sorry, question number 4. Question number 4. Not sure. And you are told that the foreign trial balance was extracted from the books of Savannah Limited as at 30th September 2017. This one. So we have land, building, plant and machinery, accumulated depreciation. We have revenue, cost of sales, Inventory, 30th September 2017. That's the closing stock. Distribution cost, admin expense, income tax, investment property at fair value. Then we have finance cost, 8% redeemable preference shares, 10% debentures, intangible assets, trade receivable and trade payables, ordinary shares, share premium, retained profit, deferred tax, bank and cash balance. Then we have investment at fair value. Additional information. Number one, the fair value of investment property as at 30th September 2017 was 2790. So number one, we have investment property. How much was the balance brought down? 2340. Then they made a revaluation at fair value on 30th September 2017 to 2790. So you have a revaluation gain. Is that 450? So where do you take this 450? Take it to other incomes. Number two, information relating to intangible assets are as follows. So we have development cost of software. It is to be amortized over 5 years. So we have amortization. So the cost is 25,800 and it's being amortized over 5 years. So you divide by 5 to get amortization per annum. Yes? 1560. 5160. Then we have patent. Then we have research cost. Bullet number 2 after that. The patent was acquired on 1st November 2014. It was determined that the patent had an indefinite useful life when it was acquired. So if they estimate that it will exist to perpetuity, that means they have not been amortizing it. Are you together? Yeah, so there is no impairment. However, on 1st October 2016, when is 1st October 2016? At the beginning or at the end of the year? At the beginning, due to a new competitor gaining ground on the company technology, the patent was estimated. Yeah, the patent estimated fair value was established to be 13.5 million with an estimated useful life of. Yeah, they made a evaluation at the beginning of the year. Let's go back to bullet number 1. How much was the carrying amount of patent? It's 15,600. Then at the beginning of the year, they established the fair value was 13,500. So there was a revaluation loss of how much? 2,100. Then with an estimated useful life of 3 years. So that means it will now be amortized. It was valued to 13,500 at the beginning of the year, and then they estimated it to have a useful life of 3 years. So you divide by 3 to get the amortization charge for the year. Is that 4,500? 4,500. Good. Bullet number 3. The research costs were incurred during the year in developing new software, which was not successful. So therefore, the company does not expect any future economic benefit. It should not be recognized as an asset. You just expense that amount. So research cost. It's an expense for the year, therefore it should not be part of intangible assets, an amount of 8280. So how much would be the intangible expense then? Intangible expense. So there was amortization of 5160. Patent, there was an amortization, loss of 21. Then amortization of 45. Then research costs need to be written off because the project was not successful. 8280. How much is that? $20,040. $20,040, right? Now, for intangible asset expense, so where do you classify that? Remember, we said that the expenses are classified into 4. It's either cost of sale, admin, distribution, or finance. Where do you take this? Assuming you're not told where to take it. Where will you take it? So this one you take under admin. Therefore, how much will be the value of intangible asset? Intangible asset, note number 2 again, we have development costs. The cost was 25,800. You raise accumulated amortization of 15,480. Then you raise amortization charge for the year 5160. So how much is the current amount? Sorry? 2160. 5160. Then you also have patent divided at the beginning of the year at 13,500. Then there is an amortization financial year, which is 45. How much would be the net book value? Is it 9,000? Then research cost, that one is to be written off. So now how much do you take to statement of financial position? Take 14,160. Good. Number 3. Number 3. The following details were relevant to property, plant, and equipment. Buildings are depreciated at 2.5% per annum on straight-line basis. Plant and machinery are depreciated on straight-line basis over 10 years. Depreciation for the current year has been provided, so that means that information is irrelevant. If they have already provided depreciation charge for the year, that means you are given the amount at their carrying amount, so that will not affect. On 30th September 2017, is it at the beginning or at the end? At the end, land and building were revalued to 25,500 and 45,600 respectively. We had revaluation of land and buildings. Let's go back to the 12 balance. Land and building. How much is the carrying amount of land? 2,100. What about buildings? It's 42,600. You minus depreciation for the building. 63,90. Give me the answer. So how much is the value? That's 6. 310. 210. Then we divided them at the end of the financial year. And we are told that note number 3, that on 30th September 2017, the land and building were revalued to, so one was revalued to 25,500 and building was revalued to 45,600. We revalued them at a gain. Give me the gain. I think these are just simple calculation. Eh? Give me your calculator. I need to finish this question before time. Eh? 45,600, 36 to 10. You get 9390. So we have a total revaluation of an amount of 14,700. And where do we take this? Other comprehensive income. Number 4. Number 4, you are told that Savannah Limited is also a sales agent for Majani Limited and is entitled to sales commission of 10% on sales made on behalf of Majani Limited. So that means Savannah is operating as an agent. The net proceeds obtained from the sales after deducting the commission are remitted to Majani Limited. During the financial year ended 30th September 2017, Savannah Limited sold good worth 2,700 on behalf of Majani Limited. This amount was included in the sales revenue disclosed in the above trial balance. I remember discussing with you on recognition of inventory. I can even recall the illustration I had given you. Remember that if you are an agent to this house, you collect revenue on behalf of the landlord. Is that amount of your, is it your revenue? We say that the revenue will be the commission you get. Are you together? Good. So in that case, they made a sales of 2,700, of which they recognize as part of their sales. So what will happen to that? From the sales. Are you together? So you debit sales with the entire amount of 2,700. Then you credit. You are entitled to a commission of 10% of the sales. So we have a commission income. The only amount you're supposed to recognize is commission income, 10% of 2,700, that is 2,070. Then we are told that the amount, we are told that Savannah Limited had not limited the net sales proceed to Majani. They have not limited by the end of the year. So if they have not limited, we have amount that does not belong to us. So therefore it's part of, we are recognized a sale of 2,700. You deduct our commission, which is 2,070. 18,630. That's how you're supposed to treat that. Number 5. Inventory as at 30th September 2017, that's the closing stock. Don't have to adjust that. So inventory as at 30th September 2017 included partially damaged and slow moving goods. The cost of the goods was $450, which were eventually sold in October 2017 for $128.4. Yeah, I remember discussing on adjusting and unadjusting. And we say that inventories, sale of inventory is part of adjusting events. So number 5, loss inventory. And we are told that inventory on 30th September 2017 included partially damaged good and slow moving good. The cost of this good were $450. The cost was $450. And they were eventually sold at $128. So proceeds only priced at $128.4. Therefore, we have loss on inventory. So take 450, 28.4, you have 321.6. So loss of inventory you added to cost of sales, you eliminated from the closing stock. Good. And number 6. Finance cost comprise. Finance cost is the same as the interest. It's the same as interest expense. Number 1, we have interest on debenture. Does interest on debenture qualify to be a finance cost? So we have interest on debenture. That one qualifies. 3, interim dividend paid on ordinary share. So that one does not qualify to be part of finance cost. Then we have dividend paid on redeemable preference share. We say that redeemable preference share, they are non-current liability. So that means its dividend will qualify to be part of expenses. So preference dividends, amount of 1,200. Then we have investment income from tax exempt companies. That's an income. So therefore it's not part of finance cost. So therefore, amount of finance cost to take to the income statement, 4,200. Number 7, the corporate tax rate is 30%. Number 8, the balance on the income tax. So number 8 is tax expense. We say that tax expense is made up of the current tax and the changes in deferred tax. And we are told that the balance in the income tax in the trial balance represent the amount paid for the year. The tax expense for the year is estimated at 7770, inclusive of an increase in deferred tax liability of 1020. So how much do you take to the income statement? Can you compute that? 30 seconds. How much will be your tax expense to take the income statement? You're getting an amount of? So you must be through. What are you getting? So to the income statement, you take 7770. You are told that the tax expense for the year is estimated to be 7770, inclusive of an increase in deferred tax liability of 1020. So deferred tax, there was an increment of 1020. Therefore, how much was the current tax? You're getting 6750. Therefore, how much would be a value of deferred tax to take to the balance sheet? Let's go to the income statement, to the trial balance. How much was the deferred tax? Deferred tax was 8470, 8490. Then during the year, there was an increment in deferred tax of 1020, which was captured in tax expense. So therefore, you add 1020. Therefore, you have an amount of 9510, right? This is what you take to the balance sheet as part of non-current liability. Then, what about the current tax to the current liability? Current tax. Let's go back to note number 8. Number 8, you are told that the balance in the income tax in the trial balance represents the amount paid for the year. That's what we paid during the year. How much was the current tax for the year? 6750. That was the current tax for the year. Then the one in the trial balance is what we paid during the year. How much was the income tax in the trial balance? 85. 8490. So how much do you take to the current? The tax charge for the year is 50, but we paid 8490. How much is the balance? 1740. So these are not overpayment, these are prepayment, therefore goes to the part of current asset. These are prepaid tax. We paid more than the tax expense for the year. Good. So the following statement in a format suitable for publication. So now with the workings, you can be able to present that. It's either yes or no. Can you be able to present that? So I don't think we have anything there. We also had depreciation. We didn't have any depreciation. This one we made during the year, so there is no other adjustment. Right? So intangible asset changes, you take it to admin expense. So let's just present the income statement. Savannah Limited. Statement of comprehensive income for the year ended 30th September 2017. Our shillings are in thousand. So we'll take revenue. How much was the revenue? Have 180. Then you minus an amount of 2,700. What do you get? That is 169, 159. 159, 330. Then you deduct cost of sales. How much is the cost of sales? So we have 65, 670. Then you add loss on inventory, an amount of 321.6. So give me that. 65, 991.6. Give me the gross profit. Sorry? 333.4. Then you add other incomes. And the other income, we had fair value gain. Number one. We have a gain of 450. Then we had commission income for acting as an agent for Majan Limited. That is 20, 70. Then you raise other expenses. We have admin expenses, selling and distribution expenses. Then we have finance costs. So admin expenses, we have an amount of 11,340. Then you add intangible asset loss, 20,040. You get 30,380. Then we have distribution cost, 66,90. Then we have finance cost. Finance cost we have is 40. 42. Give me the profit before tax. Then you raise tax expense. Tax expense was 77.70. And you get your profit after tax, which is 46,818.4. Then you add other comprehensive incomes. So to other comprehensive income, we had a revaluation gain. Land and building, they created a revaluation gain of 14,790. So you add 14,790, 61,608.4. And that's how you get total comprehensive. So go and present a statement of changes in equity, as well as a statement of financial position. Of that,